Hello, everybody. Welcome inside another Mortgage Impact podcast. My name is Jen Bates, Communications Manager for Movement Mortgage. My co-host today, the Communications Director for Movement Mortgage, Adam O'Daniel, and our special guest, very excited to have Len Kiefer on today. He's the Deputy Chief Economist for Freddie Mac. Len, thanks so much for taking time. How's your day going?
Hey, it's going great. Glad to be here. Thanks for having me.
Awesome. Now, I know we want to dive into everything economics, everything housing, but give me just a general snapshot, Len, of what you do for Freddie Mac. Give us a little insight on what your responsibilities are and your amazing Twitter feed with incredible charts and graphs that I love looking at.
Thanks for that. Yeah, so I work in what we call our economic and housing research group. I report up to our chief economists. So it's the chief economist shop. So what we do is try to help people understand what's going on in the economy, housing, mortgage markets. We do that through a lot of different things, like we publish reports on analysis. We do a forecast of housing market conditions. I'm out talking to folks like yourselves and other about what we see going on in the housing and mortgage market. And then we also advise people internally, some of our senior management and others who want to know sort of what's the economist view on what's happening or what we think might be happening in the future, try to put some perspective on the data and help them try to foresee as best we can what may be in store for the future.
So right now your job is extremely entertaining, to say the least, because goodness knows what's going to happen next. I'll start us off with questions here, and then I'll kick it over to Adam. Give me just a look right now, some high-level look at what's happening with housing, some trends you're seeing that it's just first 6 months of the year has been a roller coaster.
Yeah, it has been incredibly volatile, obviously, with the U.S. economy entering recession in March and suffering some very, very tough times with the labor market, going through very high unemployment. A lot of businesses are shut down. Consumer spending has contracted. It's been a very tough economic environment that most economists were not forecasting at the beginning of the year. This global pandemic has really surprised us. And the sharpness of the contraction was really shocking by a number of metrics, and it's certainly a tough road for the U.S. economy and the U.S. households. On the housing front, particularly on the owner-occupied housing part of the market, things have held up relatively well. And as we're in, I'm talking to you late June, and May and June 2020, the housing market started to rebound, and we saw some pretty strong readings on some of the more high-frequency data that signal that maybe the housing market is starting to get back on track, although there's a significant hole in the second quarter, particularly in that March and April time. But in general, it looks like the housing market is held up fairly well and is on a road to recovery. It may be some years before we're fully back, but it looks like a good sign. And for the broader economy, a strong housing market is definitely a positive for the U.S. economy and going to be one of those things that will help us get back on track totally as a nation.
And that's a great point, Len. I think a lot of people, including myself, so I'm an old news guy. I kind of came onto the scene with a lot of these issues back in the 2008 financial crisis. So immediately when these things started to happen, my mind immediately went back there. And I know a lot of other folks in the mortgage industry did. I know we've beat this horse to death over the last couple of months, but this is completely different than what happened then. I mean, you see recession. If you've been in this industry and you've been burned before, you immediately kind of gut reaction was probably like, oh no, here we go. Like prices are going to fall, foreclosures are going to spike, but that's not really happening, at least not in a widespread kind of case. Can you kind of talk about why this is different? Like why the housing market has reacted differently this time compared to maybe some past crises?
Yeah, the 2008 period was really unique in a lot of ways. I mean, the current environment is also unique, but if you look at most recessions in the United States, housing is not at the epicenter. Housing is very cyclical, so if you have a recession, housing tends to contract ahead of a recession and many times. But the 2008 and 9, global financial crisis, housing was front and center, and it took a long time to heal a lot of the damage that was done. Particularly home values took a long time to come back. The current environment is much different, particularly where housing was coming from. When we were looking at the housing market in 2019, thinking about what 2020 was going to look like, we were looking for a good year because there were a lot of tailwinds for the housing market. Mortgage interest rates had come down, and we were seeing very strong demand from many of the young adults who were finally sort of reaching a point where buying a home was making sense, and they were really starting to move the market. That positive tailwind remains, but it's facing enormous challenges on the macro economy. And so while, sort of housing has contracted a little bit, it's not nearly as much as it was maybe in the prior decade when we were over leveraged. You saw people were really extending credit. Home values had gotten very elevated and was fueled by a lot of credit expansion. Home values are pretty high in a lot of parts of the country, but that's because we haven't built enough housing, and so there's a lot of competition, and that's pushed prices higher. And so that competition's still there. Folks are still looking to find a place to live. In fact, in some places, you may see a shift towards the suburbs and larger single-family homes that actually support that market even more. And so we've seen home values remain pretty stable, maybe haven't declined nationally, and have held up pretty well. And the low interest rate environment is certainly helping as we starting to enter the early parts of recovery with a lot of uncertainty. And so that the housing market, instead of being, the center and a lot of issues for the economy, is actually a source of strength and provides some growth there. But by itself, it's not going to be enough. We're going to need a lot more. But, instead of being a drag, it's a lift, it's a tailwind, and there's a lot of positives looking forward in the future, and not as many of those challenges that we had a decade ago.
Man, such a great point. I know, Jen and I are in that boat, right? I mean, Jen and I are both in the suburbs of Charlotte Metro. I think what they call where I live now, I've heard this new term, the exurbs, where it's like the ring past the first ring of suburbs, right? I don't know.
Mm-hmm.
But I've seen that, Len. Like my neighborhood, it's crazy what is happening in our housing market is, those who are fortunate enough to be employed and have kind of a stable situation right now, it's tough to find a home if you're looking to buy and kind of settle down right now. It's really tough.
Yeah, we've done research on this, and the U.S. is just not building enough housing. If you look at it all in for the United States, we need to build, at least 1.5 million units, right? Single-family apartments or single-family homes, apartments, manufactured housing. We're not getting that. It took us 13 years after the global financial crisis to climb back to that level, and then the pandemic hits, and housing starts collapse when there's a lot of shelter-in-place orders around the country, and so that's going to have effects, particularly next year. If the economy is recovering and we are seeing some growth headed, all that construction that got put on delay for lots of parts of this year that can't get made up is just going to mean tighter inventory next year. And so that phenomena of, homes selling relatively quickly and seeing not a lot of homes available for sale is probably going to continue to tighten, just given the demographic forces and the pressure on the market. Home building is going to need to pick up to supply that desperately needed, housing across the country.
Right. And rates have been so low that so many people have refinanced. That means they're staying in those homes and nobody's moving around, which only adds to the pressure of inventory. But Len, I want to touch on those rates too, because it's not just low. I mean, these rates are incredibly low by y'all's own standards now, 3.13% on average as of last week. So again, this is June 17th or something like that, June 19th. What about the rates, and where do you see those going? Because they could stay low, but what are the pressures, what are the headwinds, tailwinds for mortgage rates, and where you see them in the second half of the year?
Jen, are you putting Len on the spot right now with a great crystal ball prediction?
I love Freddie Mac's website. I was telling Len, I go every 10 a.m. Eastern, every Thursday morning, I am on it. I love the Excel spreadsheet that comes with it, the history. I think it's just fascinating because there's so many pressures right now. It's not just COVID, it's an election year, it's the Federal Reserve and them purchasing, treasury bonds and where they're going to go in the future. So there's just a lot of variables for this.
Yeah, and Freddie Mac, my team, yes, what we do, part of what my team does is help produce our mortgage rate survey that Freddie's been doing since 1971. And as of last week, June 18th, right on it on the date, we reached another record low. We've had several record lows in 2020. Rates just keep on declining given the very low interest rate environments, just not in the United States, but around the world. And the Federal Reserve buying treasuries and mortgage bonds is helping to bring those rates lower, which benefits both homeowners and potential homeowners because that makes it more affordable for prospective buyers, and as you alluded to, existing homeowners can refinance and get pretty substantial savings. We looked at it in the first quarter of this year. On average, refinance borrower saved about $2,000 a year because of those lower interest rates. So that's providing its own stimulus through lower interest rates, which helps, given this trying time, that's going to help out for a lot of homeowners. looking forward, the crystal ball is really foggy. Who knows? It's very difficult to forecast rates, but most economists looking at where the Federal Reserve has signaled they're headed, they're not likely to raise rates anytime soon. Globally, interest rates are negative in many parts of the world. There's just not a lot of upward pressure on interest rates, so you may see them modestly increase if the economy starts recovering, but it's also very likely that they stay pretty low and even drift lower. Given how low Treasury yields are, you could even see mortgage rates fall from where they are today. It's not certain. It's hard to say with any kind of precision on that kind of a forecast, but most economists, myself included, are expecting to see low rates, for the next year or more. And so that's going to provide, a benefit for those potential home buyers and refinance borrowers and pretty substantial savings for them.
I have a quick question for you, Len. Yeah. I know it's a very confusing topic when you see these headlines about central banks in other parts of the world and negative interest rates, right? Can you maybe, for like the average loan officer who is trying to keep up with the industry, and we haven't really seen that in the US, but it does happen around the world. What is a negative interest rate, and like what do we need to understand about how that even works?
Yeah, it was academic 25 years ago. Folks were considering. I remember I was studying in graduate school at the time and looking at these papers written in the early 2000s, and Japan had experienced very low interest rates, not even negative, but close to zero. And there was a number of academic articles about, well, is this a unique circumstance? Does this apply? You go forward 20 years, and in Germany and much of Europe, they see negative interest rates. And so the U.S. has not yet seen negative interest rates, but it's certainly a possibility, right? And so you have to think about what that would mean. In parts of Europe where they've had negative interest rates, they've even had negative mortgage rates, which means the interest rate that you owe on your mortgage actually declines instead of having to pay, accrue with the, interest payments there. So that can happen because it really depends on how people value cash flows. If investors really need liquidity, they really need the safety of those funds, they can push bond yields to the point where they actually go negative. And so borrowers the government, usually it's sovereign, so the government actually doesn't have to pay a positive interest rate on that. Will it happen on the mortgage front in the United States? We got a ways to go. We're over 3% now, so it would be pretty dramatic. But, history has shown that it's a possibility, and it's happened in parts of the world. So it's something to consider. But I think most folks that look at the United States think that the likelihood of that happening in the next, 5 years in the United States is pretty low. It's pretty low.
And you touched on it just a minute ago, Jen. I apologize for digging in on this issue, but I know it's so important. Every week we put out our market update blog, and Jen does a great video. And I mean, if we talk about rates, immediately we're going to get more views on that than anything else. So, I think these are interesting things for folks to learn about. When you talk about where rates are headed, I mean, we talk all the time at Movement and at other mortgage companies about how the federal government in this period has used interest rates as a way in the mortgage space, to create stimulus for the economy. And you touched on that just a minute ago. Is that actually what's happening? Like, is that more than just like a little rally cry that's kind of fun to say? Like, are these low rates actually creating a stimulus for the U.S. economy?
Given the uniqueness of the fact, the pandemic and the fact that so many consumers are sheltering in place, I mean, we're starting to open up, but it's, it depends on where you are in the country. It's more of, support than stimulus. You're not going to get extra spending. It's really try to make up, for the challenges that a lot of households are facing, given, their incomes have been shut down. Small businesses have seen, their revenues decline, but helping them get through. And if you are, someone who has a mortgage and you're able to refinance into a lower rate, as I mentioned, $2,000 a year is not, enough to get you through. It's not enough to make up everything, but it certainly can help out. And that's absolutely the case. You look at the Federal Reserve policy, they've targeted mortgage-backed securities. Part of the reason to do that is to help lower interest rates that then consumers and households pay, and that helps them support them through this tough time. And as we get to the recovery stage, which maybe we're at the early parts of that in parts of the country, that'll help stimulate more spending. It'll free up funds. You don't have to pay those interest payments. You can use those to buy, other goods and services. Or if you're looking to buy a home, it can help you, purchase that home. Move from being a prospective buyer to an actual first-time buyer, which we're seeing a lot of in the marketplace, even in this challenging economic environment. So that certainly helps. It's pretty dramatic if you see rates drop from where they were just a couple years ago. They were almost 5%. Now they're a very low 3%. That's a pretty substantial movement. It provides a lot of benefit for the housing market and helps out those households and consumers and would-be buyers.
Len, I want to touch on the Fed a little bit more too, because what they were doing, what was it? Gosh, Adam, what was that? March 15th or so that I think the Fed dropped rates to, gosh, was it 0 then, or at least below 1? And we go in and do this special video because that was really big news. And then the Fed, it wasn't just that; it was jumping in to buy those Treasury bonds and jumping in to make sure that the economy was going to be stable, especially on the housing side. Most recently, Jerome Powell was testifying to Congress and talking about how the government needs to continue to step in and make sure that the economy is stable. Is their continued purchasing of bonds and their continued involvement going to last for a while, I guess, in your mind? Like, what does that need to keep happening to keep housing stable, or is it going to be okay on its own here in the next few months?
Well, I mean, I think there's so much uncertainty, and I think policy members have been flexible, and they've done a lot of new programs and things to help support the economy. And given the sort of dramatic slowdown we saw in the second quarter to battle the pandemic, a lot of that was probably needed, because if you look at sort of private spending, it just wasn't there. And so that support was very critical. And then going forward, I think they're going to be very mindful of how the economy is evolving. And you've listened to those policymakers; they talk about data dependence. You can speculate, you can try to forecast, you can build a model. I do that, right? Try to look at history, but things are totally unprecedented. So those models are informative, but aren't. It's the same thing as getting real data. And so you're going to have to watch and see, and then those policymakers are going to have to decide what they feel is the appropriate sort of level of support. But what they've signaled so far is that they are going to keep low interest rate policy in place for an extended period until they feel that the economy is well back on track. We're seeing the employment come back in. There's almost 20 million Americans lost their job. Payroll employment contracted 20 million from February to where we sit through May of this year. That's an enormous challenge, and so folks are going to need a lot of support. I think the policymakers are trying to do their best to help them, and so they're going to have to watch and see how things evolve. But looking forward, asking what is the economic environment, I think these low interest rates are probably going to stay with us certainly throughout the rest of this year and probably into the early parts of next year.
Len, what are you looking at when you're putting together forecasting and kind of, you're preparing to come on a podcast like this, and you're going to be asked about what's going to happen next year. You're asked these things. For the kitchen table economists like us and a lot of our loan officers who are listening, what are those like handful of data points that you constantly kind of look at as leading indicators of whether we're going in the right direction or not when it comes to the strength of the housing economy?
Yeah, it's been really challenging this time, particularly in March and April when the economy was really seeing dramatic swings. We had to look at a lot of non-traditional sources of data. I'm an economist, so I like to look at government statistics, which are fantastic and provide a comprehensive view of the economy, but often with a lag. So you think about housing starts data or labor market report, that's telling us what happened in May, and we're already nearly in July now. So we try to look at some more experimental indicators, things that maybe don't have as long of a history. They may not be scientifically designed, but they do provide you with some more real-time, high-frequency updates. There are a number of those, but ones that we've been tracking, at Freddie Mac, we got mortgage applications information that we collect. And so to see where the housing market is, we've been tracking that very closely, both nationally and at local levels, and what we've seen in those data has been a pretty strong recovery in the housing market, and so far through late June, it's been pretty sustained, right? And so we're continuing to see that. So looking at that sort of financial market indicators, what we're seeing in terms of applications, are people applying for loans, and then ultimately do they get funded? Those things are very, very critical, and of course rates being so important for the housing market, we track it, in our weekly survey, but also looking at what's happening in the Treasury market, what's happening with mortgage bonds, because all of those things will influence ultimately what consumers pay, and then how the housing market is going to react. So it's like we have to look at a lot of indicators. We're juggling a lot of things and trying to figure out, which things are going to be most useful, and it may vary over time. It keeps us on our toes, keeps us, trying out different stuff, trying to track and try to watch, and that tapestry of data we're looking at changes. As certain things go to zero, they're not as informative as when things are moving. So we have to sort of keep on parsing a lot of data.
All right, I've got one more question on this topic, and then I know Jen probably wants to take us home with another in another direction because we're going to run out of time. But Len, we've talked a lot about it just now, and then, we're looking at it. We talked about it with Barry Habib from MBS Highway a few weeks ago. We had him on, and there's a lot of positive things as we look into like this recovery that we're on right now, right? Like there's a lot of folks with equity, applications are up, activity is up. You've got, you talked about the rates extensively here today. But there's this pesky thing that I can't get over, which is the number of Americans that are unemployed. And like the longer that continues on, I just know from the little bit of knowledge I have on that, like eventually that just starts to really strain everything when you have people. So if I'm a loan officer, if I'm a real estate agent in the housing market somewhere, like how concerned and at what point do I need to be more concerned about that high number of Americans that don't have a job to go to every day?
Well, I think we all just need to be concerned about that because those are our friends and neighbors, and this is a real hardship for a lot of people. The owner-occupied housing market has held up a little bit better because the folks who have been most impacted tend to be more renters. So we've looked a little bit at the detailed information on who has been unemployed, and a lot of those folks have been folks who tend to have lower home ownership rates. So it hasn't immediately impacted the homeowner population as much as the headline numbers. However, that's sort of the first order effect, and we haven't seen how things unravel, right? We've had this very sharp, shock to the economy. Businesses are going to have to evaluate that, and as they see that, they may have to pull back on their spending, and then that starts to affect sort of everyone. And so the longer that unemployment stays very high, as long as businesses are shut down or they're failing, that's going to put more and more pressure on the U.S. housing market. And eventually, if that doesn't start to get on recovery, it will overwhelm the benefit of low interest rates and some of these short-term policies. So it's absolutely critical that the broader economy starts recovering and that we see that. We sort of may have weathered things a little bit because of the initial blow, but it's those second-order effects, what happens in the fall, what happens in the next spring, that's going to be really important and something that we should be watching out and thinking for beyond just, hoping that our friends and neighbors are going to do better than they had after going through such a tough time.
Yeah, 100% agree. People don't think about it that way, right? Like they see the headline number and then don't realize there's, like you said, secondary and tertiary effects that that have that undercurrent, that ripple under the economy that can really affect a lot of things. So, Len, Movement, very positive company. Usually, we like to keep things on like the okay. Well, tell me how I can help because I would like to help type of attitude. So, what are your thoughts that are positive? You're taking into Q3, Q4 of this year, maybe even into the early part of 2021. What are some things where you have your eye on that you're like, okay, we can build off of this, and this is a positive we're going to take beyond now?
Yeah, economists, they call us the dismal scientists because, we're looking at things often with, half is glass is half full. It's part of our job. I think I'd get my economist credentials taken away if I came on and was all cheer, although I try to be optimistic. But I do think there is a good story there for the U.S. housing market in particular and the broader economy. And, as I thought about where the economy was going to be in April and May, I've been surprised on the upside. Housing market in particular has done pretty well. A key question I have in my mind is that some recovery? We typically have a big spring selling season in April and May that leads to a lot of transactions. Maybe that got delayed a little, so some of the strength is just that seasonal getting shifted, and then will it be sustainable? It's a question. But I tend to be optimistic about the U.S. housing market because of low interest rates and because of the positive demographics. And so the low interest rates are likely to stay with us, and we definitely have those demographics. You have young adults coming of age that are looking to buy homes, and that's going to provide a lot of demand. And so I think from a industry, I think given significant challenges self-set us certainly get on the road to recovery, and ultimately I think lead to some pretty positive years for the industry if we can get the broader economy on track.
Len, man, thank you so much for jumping on with us. This is tough when we have to do everything virtually, and you've been awesome, man. Thank you so much for joining us on this podcast. Jen, I don't know if you've got anything else that you want to, kind of closing thought or anything, but I just, let me reiterate what a great friend Freddie Mac is in our industry and in our business. I know Jen and I rely on it every single week when we're putting together our market update. I know all of you listening do the same thing. I mean, they are the go-to for that weekly survey, and Len and his team just does a great job. So thanks for joining us today.